Started. Okay. Thank you. A special thanks to Trisha for this initiative. I was so happy when, you wrote to me that whether it's possible, of course it's possible.
We're
Thanks.
glad you accepted, ma'am. Thanks a lot.
And, thank you. So Trisha asked me to speak on the public finance in the times of uncertainty. So before we get into the public finance, yesterday was Central Bank's MPC meeting. So against the backdrop of this MPC meeting, we will analyze, what's happening with the dynamics of the public finance, because fiscal policy and monetary policy, these are, correlated, and we need to look into the public finance issues from that perspective of fiscal and monetary policy coordination. So yesterday, the growth numbers are out, the inflation projections were out. You can see that articulation of central bank governor yesterday was little different from, the articulation he has done to the MPC meetings prior to this. Since May 2020, we kept our policy rates, the repo rate constant at 4%, and we announced many economic stimulus packages. It was actually a heavy lifting from the part of RBI, and a lot of liquidity infusion to support the system in the times of COVID pandemic. But right now, with the global uncertainties, when the war is mounting, when there is energy price volatility, and when there are issues related to mounting inflation, can RBA take a stance that growth first and then inflation? So that was a policy dilemma, and many economists and policymakers, they anticipated that RBI may continue in the path of growth first, inflation later. But if RBI bites a bullet and increase the interest rate, then growth recovery process may suffer. So that was a hunch. But later we understood that, given that change situation and the mounting uncertainties due to the COVID pandemic and the war in Ukraine, the sequence of priority needs to be shifted from the growth to inflation, because mounting inflation, that, affects poor people the most. So what exactly RBA has done? Look at the rates. The rates are unchanged. If you look at the repo rate is kept constant or status quo at 4%. Reverse repo rate is also kept at constant, that is 3.35 since May 2020. So what exactly has happened? And the articulation is that, they maneuver the policy corridor. They started absorbing the liquidity in the system by getting into an announcement of a new policy tool, that is, standing deposit rate. So this SDR is a new tool, but if you look at the Urjit, Patel committee recommendations, this tool is, of course, he suggested this tool to absorb the excess liquidity. But after such a long time, yesterday in the MPC meetings, that the standing deposit rate was announced. But then, is that reverse repo rate redundant? You may ask that question. But of course, it may be redundant because it is at 3.35. The manner in which it was done, it was kept constant and lower at 3.35 to, nudge the commercial banks to enter into, the credit deployment and to support the demand stimulation. But if you look at the credit deployment statistics and if you look at the parking of the commercial banks back with the RBI, what we can see is that, the tendency of the commercial banks to park with the RBI, that it's above SLR. So there is an SLR requirement, that is a statutory liquidity ratio, but that excess parking of the liquidity back at the RBI, how to deal with that? That's why this SDR is introduced, and it is a powerful, tool to absorb the short-term liquidity. So we have to wait and see. But in that sense, if liquidity absorption is hawkishness, then of course RBI has gone into a hawkish mode. If you look at the monetary policy corridor, the articulation was not the RBI has gone from the accommodative policy stance to the neutral policy stance. Rather, the wording, that communication was little different in the sense, RBI governor, he articulated that we started, withdrawing that excess liquidity. We started the process of, going away from that accommodative stance. So that's the way it was getting articulated. But the articulation was not that, RBI has gone from the, what you call the accommodative stance to the neutral stance. No. So repo rate is at 4%, reverse repo rate again at 3.35. It's almost redundant now when you look into the liquidity absorption that's happening through this new tool, as well as the variable reverse repo rate. That's the cutoff yield rate. If you look at, that's 3.99. So this FRRR, that is fixed reverse repo rate at 3.35, it's getting redundant. And now get into the credit story. That was the predominant narrative of the Indian government and the RBI to support the economy, the weak economy in the times of pandemic. But, students can take a look into the work by Stiglitz and Rashid. In that paper, which economic stimulus works, that's the title of the paper. In that paper, they have clearly mentioned that the credit-related deployment or credit-related economic stimulus packages have limited multiplier effects. Why? Because if the credit deployment is huge and if there is no corresponding increase in the growth of economy, then, that can lead to mounting NPAs, non-performing assets, that's going to be another issue in the future. And also, the credit deployment, if you look into the statistics, that was quite uneven. So Indian economy may be recovering. In the economic survey, if you look into the data, was the economy will grow at more than 8%. But if you look at the articulation of RBA yesterday, there was a surprise. Surprise elements were many, but one of the surprises, they have done a downward revision in the growth rate. So it's around 7.2. And look at the inflation forecasting. You know that based on the inflation targeting in India, the sole objective of RBI is to look into the price stability. But then, increasingly, including Jayant Verma, the NPC member, many economists highlighted that there is reputation risk for RBI because, inflation is mounting, but they are keeping the repo rate at status quo at 4%. So they are not responding to the mounting inflation, because if they bite the bullet and increase the interest rate, then the growth recovery process will suffer. So the growth first, that was a narrative. But given the changed circumstances, this is the first time ever after that May 2020 announcement, but we are thinking seriously about reverse the sequence of priority from growth to inflation. Now the priority is inflation first and then growth. Because, you can understand that in the context of the war in Ukraine, many things are happening. The ship lines are getting affected. The consignments are getting delayed. There are problems related to trade, supply chain disruptions. So these are leading to supply side inflation. So to a certain point, we can say that the inflation is transient. But after that, what? So we need to respond to that. So, that was a dilemma, but RBI has, bitten the bullet. They have increased the, increased in the sense they have looked into the suction or looked into the process of absorbing the excess liquidity into the system by introducing a new tool. But reverse repo rate, maybe in the next IMPC meetings or in December, we need to see what's happening to the reverse repo rate. Because, from the public finance perspective, RBI is also doing a public debt management. So when you look into the debt management perspectives, the policy rates needs to be lower. And this is always a tug of war between the RBI and the North Bloc. You have to keep the rates lower, because otherwise the borrowing costs may grow higher and higher. So that's one dilemma. So to keep the interest rate lower from the perspective of the public debt management is crucial. Because otherwise the financing of deficit, the predominant mode of financing the deficit is, bond financing. So that can lead to, high costs of borrowing when you look into the perspective of RBA as, a public debt management institution. So these are the policy dilemmas, but mounting inflation we need to address. Otherwise, if you keep the inflation at a lower point, what would have happened? RBI would have failed to anchor the inflationary expectations, because inflation is based on that inflation targeting framework. What exactly is the inflation targeting framework? As per the new monetary policy framework, based on the Urjit Patel recommendations, what India has done, we pegged the policy rates based on an inflation anchor, which is 4%, then its deviation from the inflationary expectations, and an output gap. So this inflationary expectations and output gap, these are, unobserved variables. How to deal with this? Inflation expectations, we started doing inflation expectation survey. Then what about the output gap? Output gap is exactly the difference between your potential output and the actual output. And actual output, that the GDP numbers are out. GDP is based on the GVA and the FISC. The GVA is a gross value added, and FISC is indirect taxes minus subsidies. So that's a methodological revision that has happened, and we got the GDP numbers. That's fine. But potential GDP is unobserved. How do you calculate the potential GDP? So usually what RBI and North Block, what they do, they get into this econometric methodology of filters. You take the series, filter out the cyclical components, and take out the trend of that series and call that as potential. So that's a way, the potential output is generated. But of course, this potential output is a quite controversial variable, because first, of course, filters has its own limitations if you look into the econometric methodology. And another thing, you cannot call that trend as potential. Potential is an envelope concept. So these are the different kind of macroeconomic questions, and why output gap is controversial, this we will enter into a little later. But come back to the point, inflation is based on the inflationary expectations and the output gap, and that's the inflation targeting formula. So when RBA was giving importance to growth first narrative, the efficacy of inflation targeting to control the inflationary expectations and inflation in our country, that was getting questioned. That will of course lead to reputation risk of the central bank governor and the MPC committee members. Why they, despite the inflation mounting, why they are not addressing to that. So yesterday's articulation was not very clever, very brilliant from that perspective, by introducing a new tool without touching the reverse repo rate and the repo rate, and getting into a new policy tool to absorb the excess liquidity. That's welcome. It has got its own repercussions with the bond yield, its own repercussions with the cost of, borrowings of the government. So many things. And also, I need to tell you, the global uncertainties are not just due to the war in Ukraine and, the global uncertainties in the financial sector, in the financial markets. That's also happening from, US Fed Reserve policy decisions. In the sense, if the US Federal Reserve, Chair Jay Powell get into a series of increasing the interest rates, recently they have even revised their mandated nominal anchor, because these are the questions which has got its own lessons for India, whether if the yesterday's RBI MPC meetings, if you look into that press release, you can understand that the inflation forecasting, they have gone up to nearing the 6% target. If consecutively in 3 quarters, if they are moving 6% above 6%, what exactly we are going to do then? Because by mandate, inflation targeting is 4%, and we have a band plus or minus 2. So officially, the comfort zone of inflation is up to 6%. So in 3 quarters, if it is beyond 6%, then what exactly is going to be the implication? That in a new monetary policy framework, that mandate itself, we need to amend and to revise that 6%, the upper bound. Of course, if you're not touching that 4% nominal anchor, You may play with that plus or minus 2 to plus or minus 3. That band you may change. So these are the questions now coming up. But God forbid, it should not happen like that. Hope the RBI will be able to anchor the inflationary expectations, and we will be able to keep the inflation up to 6%. Now, RBI is looking into the CPI-based inflation. But when we talk about the inflation, there are two, WPI-based inflation and CPI-based. WPI-based, that's mounting above 13%. But that's not the RBI cup of tea, right? RBI is looking into only CPI. So the divergence between this WPI and CPI is another matter of concern. Because WPI means the business firms. These interest rates, directly affect their plan. So this divergence between the WPI and CPI is also a matter of concern. So this, why I'm emphasizing on inflation, this moment, if you look into the questions regarding the macroeconomic crisis related to Indian economy, it is the mounting inflation that we need to look into from monetary policy side and the fiscal policy side. And I mentioned about the global uncertainties that's not only happening from the war in Ukraine, but it's also happening from the Fed Reserve, because they are getting into a series of announcements of raising their interest rates. And also, they will reduce the balance sheet of the Fed Reserve. All these things will have repercussions, and it is called as beggar thy neighbor kind of a policy from Fed Reserve. Why? Because the emerging markets, it's going to create a huge crisis, this taper tantrums and all. Why? Because there will be interest rate differentials, and a component of our foreign capital is hot. And this hot money always respond to the interest rate differentials applied to the place or the country in which the interest rate is higher. So to avoid the capital flight, we need to increase the interest rate. So mounting inflation, global uncertainties, the uncertainties related to capital flight, and also the financialization of savings. Financialization of savings, it's coming down because our rates are not attractive, so people have started, taking away their money because also, you need to look into the question of negative real rates of interest. Look into the inflation rate and the nominal interest rate. Nominal interest rate, I mentioned that since May, 2020, we kept it at 4%. Now the interest rate is up at 6%. So we are into negative interest rate quadrant. What does it mean? In the pension markets, if a huge chunk of your parents' savings in the pension market, if it's in the negative real rate of interest, means they're not even getting what they have, deposited. And in the term, deposits in the banks, if the interest rate is in the negative quadrant, the real rate of interest, then, people start, taking away the money from the bank, from the term deposits to, other, instruments for savings. So financialization of savings also require the rates to be little up. So hawkishness, how do you interpret hawkishness? If you interpret RBI as hawkish only when the rates are revised, of course, RBI is not hawkish. But, if you look into the new instruments they have announced yesterday to tackle, this excess liquidity in the system, in that manner, if it is linked to liquidity, then of course, from the yesterday's announcement, you can see that RBI has gone from dovish to hawkish mode. And another way to interpret is normalization procedure. So we were waiting, but now it's earlier than expected normalization procedure that has happened, because we thought that it's going to be a post-pandemic strategy of the monetary policy that they will get into the normalization procedure, because normalization procedure means they have to absorb all what they have announced as a part of economic stimulus package programs. But if they get into that mode, it can affect the growth recovery process. So, but now, given the change in the situation from the global scenario, given the global uncertainties, RBI has given the articulation that they are getting into a kind of normalization process by absorbing the liquidity, by using the VRRR, that's a variable reverse repo rate, that is at 3.99%, that's a cutoff yield, and yesterday's SDF, that's at 3.75. So this 3.35 reverse repo rate is now almost redundant. So that's a story of what has happened just yesterday with the RBI. Now, getting into the fiscal policy. What was the articulation of Finance Minister? The articulation was that given the limited fiscal space, we will give importance to the public sector investment, the public infrastructure investment. And the articulation was that this public investment will crowd in private corporate investment, because there is no, a private corporate investment that's mounting into the economy. We have done many reforms. So what was it missing strategy? The missing strategy was investment in the capex. We have fiscal rules in India, and over the years, what has happened with the fiscal rules, you know the story very well, because if you keep the the deficit to GDP ratio at 3%, and if you have to do that through expenditure compression, because in the times of revenue uncertainty, your taxes will not be buoyed. So you have to get into, expenditure compression methodology. And expenditure compression, revenue spending beyond a point you cannot compress, because these are committed expenditure. So over the years, if you look into the numbers, in order to reach that 3% fiscal rules, that threshold ratio of fiscal deficit to GDP at 3%, we have done quite a bit of capital expenditure compression. And that has got its own repercussions in the economy in terms of economic growth, because economic growth should be investment led. And if you look into the numbers of growth, over the years, what we have seen is it's a consumption led growth, and the capex was plummeting. So now there's a correction, a course correction over there. And Finance Minister, from a position of strength, she announced, or she refuted the neoclassical arguments that high public investment crowds out private corporate investment. This is what is a textbook economics. But in the context of emerging economy like India, empiric evidence proved that, that's exactly what was the narrative of Finance Minister as well, proved that public investment and private investment, it's not a $1 increase in the public investment leads to $1 crowding out of private investment. It's not dollar to dollar displacement. Rather, it crowds in private corporate investment, because it's infrastructure that's very crucial for the private sector to come in. So that's a narrative. And, I have written a book that's prior to the pandemic. And the title of that book, I think it's a part of Delhi University in, that book, the title of the book is Fiscal Consolidation, Budget Deficits and Macroeconomy. And my articulation was exactly what Finance Minister right now, from the position of strength, she spoke that high deficit is good. But when I published a book that was prior to the pandemic, then the country was in the mood of FRBM, fiscal responsibility and budget management. So that time, when I argued that a timely fiscal deficit is good, because otherwise this expenditure compression rather than the tax buoyancy, if that is a path to the fiscal consolidation, the quality of fiscal consolidation will suffer. So that was a basic message of my book. And I looked into the impact of the deficit into other macroeconomic variables. And this crowding out issue was one chapter. I looked into the direct crowding out and the financial crowding out, and the articulation or the empirical evidence that came from the econometric analysis, over time. If you look into the high frequency data analysis or the long-term data analysis, the articulation is that public investment is a crucial determinant of the private corporate investment. And we cannot say no to high fiscal deficit if that high fiscal deficit we are using to substantiate with greater enhancement of capex. So that's welcome. So high deficit is okay if it is used for increasing the capex or reducing the output gap. And this is exactly the articulation by Oliver Blanchard. Students can take a look into his paper in American Economic Review in 2019. And his presidential address in the American Review Association in 2019, that was prior to pandemic. And, I was there, it was my privilege to listen to his presidential address in Atlanta. I went to present my paper there. And the last slide, I still remember, he mentioned that if R is greater than G, the real rate of interest is greater than the real growth of economy, then of course we are getting into a bad equilibrium of high debt. But if the R is not greater than G, then we are quite comfortable. So we need not bother about this threshold ratios of 60% to GDP public debt, 3% of GDP fiscal deficit. No, we need not get into this threshold or the fiscal rules in the time of recession or in the time of pandemic. Why? Because getting into that, if the revenues are not buoyant, that can lead to expenditure compression. And if expenditure compression happens, that will have adverse growth recovery process. So that's the basic message. And he also mentioned that if you want to get into this fiscal rules, keep it as a contingent fiscal rule, but don't use it in the time of pandemic. And that exactly what's happening in the Indian economy right now. If you look at the articulation of the fiscal rules, instead of 3%, the students may be wondering why in India the deficit have mounted up to 9.2% in the last budget. Right now we pegged it to 6.4 in this budget. So we have to wait and see in the next revised estimates. We were able to, do that 6.4, which is pegged right now, and 6.9 is a revised estimates when you look into the 2021. But we pegged 6.8. A slight fiscal slippage is over there, but the fiscal consolidation map is medium term. So investors' confidence will not suffer. So when the finance minister was articulating about her high fiscal deficit number, that communication was very important to keep the accommodative fiscal policy stance. And that communication was like, I'm using my high fiscal deficit for the capex, for the capital infrastructure, which can crowd in private investment. So that communication was very relevant. And if you look into the articulation by Geeta Gopinath, the IMF, they also articulated that right now, getting back to strict fiscal rules can affect the growth recovery process, keep the fiscal policy stance accommodative. That's a stand from IMF as well. So you can take a look into the articulations by Geeta Gopinath. In her talk also, you will be able to understand what stand the multilateral organizations like IMF when you talk about the public finance in the times of pandemic, in the times of uncertainties. Of course, that should be an accommodative fiscal policy stance. Just one moment. Hello, I'm online, taking class. Yeah, I'll just get back to you. Thanks a lot. So, I mentioned that in the articulation of IMF as well, we are getting into that accommodative fiscal policy stance where the fiscal rules that is not kept at 3%, but it was, revised upward. And if we look at the articulation of Government of India, we know that, 4.5, that's what the excessive deficit procedure, excessive deficit procedure in the sense that in the long term, what exactly it should be. Why we are not going back to the 3% then? 3%, that was the initial FRBM. But 9.2 fiscal deficit to GDP, that happened not because of the new expenditure priorities that has happened in the time of pandemic. It has also happened due to, budget transparency. What exactly is a budget transparency? In the time of pandemic or the time of uncertainties, another crucial thing which you need to understand from the public finance perspective is budget credibility. So the government can announce one thing and, after 1 year, when the revised estimates come, you can understand that there is a huge deviation between what was announced in the budget estimates and the revised estimates. And when the actual numbers will come, the deviation will be further. Why that's happening? What you announce and what you own, why this is different? Why your estimates and the actuals are different? So this is the question related to budget credibility. So you need to look into that. And another thing is there are a lot of off-budget borrowings. Off-budget borrowings in the sense, by definition, the fiscal deficit doesn't capture the borrowings that's happening through the public sector enterprises. Public sector enterprises in the sense, including the power sector, there is a concept called public sector borrowing requirement, PSBR. That's an ideal concept of deficit. So Indian government has not yet calculated PSBR. So if you want to look into the correct number of fiscal deficit, you need to look into the PSBR. We don't have the PSBR. PSBR is the general government as well as the public sector deficit. So everything is there in the concept of PSBR. So if you're looking into the impact of the deficit on the macroeconomy, PSBR could be the ideal concept of deficit. But deficit is, of course, the second best concept of deficit. But this off-budget borrowing that's happening through the public sector entities and the corporate bodies, that's not captured into this fiscal deficit. Last year, a portion of that is corrected. That's why that because of that budget transparency, the numbers have gone up to 9.2. So it's not exactly the new expenditure priorities. If you decompose that fiscal deficit number, it's a combination of the budget transparency, revenue fall, the revenues were uncertain, and little bit of new expenditure priorities. It's a mix of everything. That's why in the excessive deficit procedure, you are anticipating that we will reach up to 4.5% of deficit, our fiscal deficit to GDP ratio, but not the 3% as we visualized in the original FRBM. Okay. Now, golden rule of fiscal rules. What exactly is a golden rule? Golden in the sense, whatever you get through the revenue receipts, you use that revenue receipts to finance your revenue spending. Means whatever you're going to borrow, that will go completely into the financing of the capex, the capital infrastructure. That's an ideal situation, but you cannot give emphasis to golden rule in the time of pandemic, because revenue spending is quite crucial. And if the revenue receipts and revenue spending, they are not equal, you cannot curtail revenue spending. In the last budget also, you have seen that the revenue spending was curtailed, and that will affect the financing of human development, including education, where the digital divide is strong, and we need to look into the digital divide issues. In health, of course, more than ad hoc, health spending, we need to look into the sector where the health expenditure to GDP ratio was less than 1% at the union government level. So we need to enhance, and we need to take that sector quite seriously, and look into the employer of last resort policies, because when everything else fail, government has to act as an employer of last resort, ELR policies. So that is also very crucial. And now the articulation of participation income versus basic income. Indian government has not yet announced a huge fiscal stimulus package in the time of pandemic in the form of cash transfers in the hands of people, because the assumption was that the propensity to save will be greater than the propensity to spend. If that is the case, then it cannot stimulate the economy. So we have entered into only a very targeted kind of cash transfers into the hands of Kisan. And of course, into the care economy, in the first Atmanirbhar package, we announced a little bit of targeted cash transfers. Other than that, of course, Indian government is emphasizing on participation income rather than the basic income. So that's the way it is. Now, it is open to debate whether golden rule needs to be phased out right now. The revenue deficit, phasing out of revenue deficit is going to be quite cruel in this moment. And my final point, because we can always open the floor and I will take the questions, but my final point here is, it's not only the levels of deficit that matter. We need to look into the financing pattern of deficit as well when we talk about the public finance in the time of uncertainties. And the predominant mode of financing the deficit in India is bond financing. And that was quite a clever shift from the seigniorage or the monetized deficit towards bond financing. We have gone away from the monetized deficit because of the inflationary pressures, and of course it led to fiscal profligacy. because it's like printing money and financing deficit. It's not exactly that, but the RBI is helping government of India in financing deficit by increasing the net RBI credit to the government. And also it can happen through the ad hoc treasury bills. So these are the ways. It's not exactly printing money, though we, for the layman, in the layman's language, for the wider audience, we may say that print money and give, but it's not exactly that. It's net RBI credit to the government. Students may take a look into that data on reserve money. Hyperword money, a part of hyperword money is monetized, that is net RBI credit to the government. Another part is forex reserves. In these two components, we need to control that reserve money in the system or hyperword money in the system. So we controlled the net RBI credit to the government, or we control the monetized deficit, because otherwise HPM, high HPM and high reserve money, that leads to inflationary pressures. But forex is booming, and a part of that forex is hot money. Hot money reflects to the interest rate differentials. So these are interrelated. And technically, what exactly is synergy? You can calculate by change in the hyperword money to GDP. That's synergy. So, and even there is a synergy Laffer curve, like till what point you can go ahead with synergy financing, so that, you may not have huge inflationary repercussions in the economy. So that inflation Laffer curve will give you the threshold. So these are the quick points. And, green bond, that's a new way of financing deficit, which is earmarked to the climate change commitments. And climate change commitments, that's a very crucial component when we talk about the public finance in the time of pandemic. Because, there is a debate that whether monetary policy or fiscal policy stance is great in looking into the climate change commitments. And economists are divided with respect to the power of monetary policy in addressing the climate change or the climate change related risk and uncertainties. And, the argument is that they don't have enough toolkits. So fiscal policy, the public finance in the time of uncertainty, has got a huge role to play in climate change commitments as well. And the green bond is earmarking of that financing of bonds in that bond financing pattern. It's a kind of earmarking for a specific purpose. It's a first experiment in India, that earmarking the sovereign bond towards green infrastructure. So that's an experiment, and we need to wait and see how this policy will be done in future related to climate change. And there are innovations happening in the Indian economy, including the CBDC, like central bank digital currency and crypto. So that was a powerful announcement in the budget, that we are going to tax the speculative asset called crypto. But crypto, that's a speculative asset. It's only a minute segment of Indians deal in that high risk, high return asset. But we need to protect those entrepreneurial aspirations, because if that is leading to smoothening of cross-border transactions for the entrepreneurs, we need to support that through regulatory frameworks. But there is a hunch that crypto may get banned in the context of Indian economy, because that announcement of 30% tax on crypto was not to make the tax legitimate or venerable or legal. That was the articulation in the press conference given by many tax officials and finance minister. But using tax policies, we are sort of curbing the speculative things happening in the Indian economy, because it has got its own repercussions for the financial instability. So these are matters of concern. And CBDC is, of course, it's a digitized legal tender, and there are issues related to data privacy and financial integrity when we talk about the digital currency. And the huge issue is the digital divide. Like, how many Indians have access to
कितने Garima, please mute yourself.
Okay, so there are huge issues.
Ma'am, I'll just mute her.
लेके आना पड़ेगा.
Yes, ma'am.
Okay. Okay. So the digital divide is a huge issue. Access to digital infrastructure is quite crucial. But of course, students can take a look into the work by Barry Aiken Green. When he talked about the digital dollar, he mentioned that the Treasury Secretary Janet Yellen has emphasized on, the digital dollar to strengthen the financial inclusion. And also she talked about like monetary policy, fiscal policy coordination will be better in the time of pandemic through the digitization. So these are issues we need to take a look into that. Regulatory framework is crucial, but don't ban it. So that's the way, I look at it, that evolution in the money and finance, we should not say no to a financial innovation, but of course it has got its own repercussions on financial instability. So regulatory framework is quite crucial. So that's it. So I stop here and look forward to your questions. Over to you. If the students are putting their questions in chat box, I need help. Tanu or Trisha can read that question for me. I'll answer. You have a question. Okay.
Tanu, are you reading out?
Yes. The first question is that in this war situation, how much extent is a common man facing financial difficulties in their normal life?
There was some network issue. Can you repeat the question? I'll write down.
Tanu, I will speak. Okay. Ma'am, in this war situation, the question is, in this war situation, to how much extent is a common man facing financial difficulties in their normal life? Is it audible, ma'am?
Yeah, I just got into my chat box, some disturbance. I think it's from my end because Deepak's voice also was not clear, but I can see the question now.
Okay.
In this war situation, to how much extent is common man facing the financial difficulties in the normal life? Right. Okay, I'll answer to that question. Then Charlie's question is, in the COVID situation, what obstacles did the government face to raise public finances? Good. Tanya, your question is, why does economic uncertainty affect firms' financing decisions? And how can we reduce the impact of uncertainty in the time of in public finance and its birth? That is by Anshika. And Shreya's question, ma'am, RBA recently said that the stance continues to be accommodating while focusing on the withdrawal of accommodation. Yeah, you got it right. What does this refer to? Then Pooja's question, given the rise in inflation, the supply side phenomenon, mainly due to the rise in crude oil prices, how effective will be monetary tightening without government cutting the excise duty on petrol and diesel? Oh my God. Very good question, students. Pooja, Shreya, Anshika. So I will try to answer. So let me start from the monetary policy perspective and then get into the fiscal policy side. Okay, if there are further questions, then we can take it later. Pooja, you're right that we are getting into a withdrawal of accommodative stance. That articulation, you got it correct, that, RBA has not said that, we have started a neutral stance. So that articulation is quite crucial. You understood that correctly. One moment. Excuse me. What exactly is a monetary policy corridor? Monetary policy corridor, the reverse repo rate and the MSF, the marginal standing facility. That's an overnight, rate in which, commercial banks can park their money, that excess liquidity with the bank. So that corridor, we need to narrow. So right now, that reverse repo rate was kept at a very low level so that, the central bank can nudge the commercial banks to get into the credit deployment. But we increasingly realize that the banks are parking their excess liquidity back with the RBI above the SLR requirements. So why should banks do that? It's a long-term phenomenon. And Urjit Patel recommendations, as I mentioned, they have looked at this question that why banks are parking their funds above the SLR requirement instead of credit deployment. Of course, it's 100% safe, 100% liquid, it's gilt-edged, everything is fine. The other things like it can lead to mounting NPAs, and it's a quite a risky affair if you are not sure about whom you are lending. All those issues are there. But at the same time, commercial banks say that it's because of the lack of demand in the economy they are doing with this reverse, parking their funds in the reverse repo or with the RBI. That's fine. But how we need to tackle this issue of excess liquidity. That's why this SDF, a new policy tool, was announced in the Indian economy to absorb this excess liquidity without collateral. So that's the way it has happened. But the question here is, I forgot her name. She asked me a very brilliant question. Can inflationary expectations channel take into or incorporate the supply side economic shocks? When the exogenous supply shocks from the energy price volatility and many components can, inflation targeting, can it incorporate these components through inflation expectations channel? Yes and no. But RBA always defend that they're anchoring the inflation expectations even when the supply side shocks happen, and they will be able to maneuver. That's why, of course, as you pointed out, inflation is not strictly a monetary phenomenon in India. Supply side shocks are very crucial. Then RBI, using the new monetary policy framework of inflation targeting, how they can control the inflation. That's a brilliant question asked by the student. But, the way in which it happens is to anchor the inflationary expectations. And right now, RBI is very, bold in, articulating that they are able to control the inflationary expectations. But of course, if the inflation goes beyond the comfort zone of 6% in the Indian economy, above 6, 4+2, that band I mentioned, in 3 consecutive quarters, then of course, you have to say that the inflation targeting is at stake. RBI is not able to control the inflationary expectations that's happening from the price or energy volatility or any other supply side shocks. So we have to wait and see how they anchor these expectations. But keeping the rates lower, this anchoring of expectations may not be possible, but growth recovery can be supported because we need cheap credit, that then investment will happen, then growth recovery will happen. So that's why we are keeping the interest rate at low rate. But as I mentioned, it's affecting the financialization of savings as well. Now, in the time of revenue uncertainty, that public finance, how it is, how shaky it is, that's a very good question. Because of course, revenues are uncertain. And we cannot do expenditure compression because it affects growth recovery. So what were the ways in which we try to enhance the fiscal space? That was a concern by the student. Of course, we looked into the non-tax revenue because tax revenue, of course, it was uncertain. But, in the last budget, we saw from the high frequency data that little bit tax buoyancy was there. It helped us. But in the long term, if you look into the last 2 years, of course, the revenue tax buoyancy was not quite good. And Indian government focused on the non-tax revenue. Non-tax revenue in the sense, they got into the capital side, the capital receipts, non-debt creating capital receipts, especially disinvestment proceeds. Or they got into the privatization as one of the important method to enhance the fiscal proceeds. But if we look into the fiscal marksmanship analysis, that is when you compare with the aspirations and the reality, it was like, it's a huge deviation between what government predicted that we are going to get this much fiscal proceeds from the disinvestment and the actual, there was huge deviation in the last 2 years. So in this year's budget, the government is quite realistic and, their numbers are quite conservative with relate to the tax buoyancy, the tax projections, and the disinvestment or the privatization proceeds. But we need to wait and see, because given the global uncertainties, war in Ukraine, this disinvestment proceeds will also be quite shaky, and fiscal marksmanship will suffer this year also because of these uncertainties. But, you cannot argue that the fiscal marksmanship always happened due to the bias of the policymaker, or the assumptions of the policymaker has gone wrong, or something wrong with his projections in the model. It can also happen due to randomness. There's a study in NIPFP where I work. We have done a huge study on the fiscal marksmanship or the budget credibility analysis, looking into the macroeconomic parameters. And we understood that the disinvestment proceeds, the fiscal marksmanship suffer the most. And when you look into the intergovernmental fiscal transfer mechanisms, that's also another way to enhance the fiscal space. Macroeconomic uncertainties are not just confined to the center government. It is also a concern for the state government. So state governments, it's not only the own tax revenue handles, the intergovernmental fiscal transfer mechanism is also very relevant when you talk about the subnational fiscal space. So intergovernmental fiscal transfer, the tax transfers, and central government has got a tendency now to increase the number of cess, because cess is not a part of the divisible pool. So that's like eating into the divisible pool, which is an entitlement for the states. That shouldn't happen for a long time, Of course, there is a tug of war over there, but intergovernmental fiscal transfers, that volatility in the intergovernmental fiscal transfer, especially grants, that can affect the fiscal space available for a finance minister at the subnational government level. So we need to look into the fiscal space at all the three tiers and work with that. So tax, non-tax, capital receipts, non-debt creating capital receipts for the subnational government's intergovernmental fiscal mechanisms in the form of conditional and unconditional transfers. So these are the different ways in which we increase our fiscal space. And natural resource taxation, unlike many countries, is not a part of Indian government. In the part of if you look into the intergovernmental fiscal transfers also, natural resource taxation is not a huge part of it. We already have some royalty in the non-tax revenue. But if you take that seriously, earmarking of the royalties you receive to the human development purpose, so some kind of earmarking is also quite plausible. So you may take a look into those kind of how to enhance the fiscal space through the non-tax revenue, not only focusing on the tax. That is very crucial. And second, in the time of pandemic, increasing taxation and calling it as COVID tax to enhance the fiscal space is going to be detrimental, because that will affect the disposable income in the hands of people. That's why we have not reduced the rate, which would have immediately trigger the demand. Economists asked a question to the finance minister, but she mentioned that, of course, I didn't decrease, but I didn't increase also. Stability and predictability in the tax system is quite crucial when we talk about the public finance in the time of pandemic. So that's why we were not getting into using taxation as a policy tool for enhancing fiscal space in the time of pandemic. But of course, there are different opinions about why can't you tax the high 1%, the high income quintile. These are questions, but it is not cross subsidization if you're talking about a huge pandemic package to tackle the uneven recovery, because one of the questions raised was how it's affecting the poor people. So the articulation that we cannot cross subsidize because the taxation sources in Indian economy is just around the population around 4% or 5% is paying taxes, and we cannot use that tax to cross subsidize the poor people. That argument is quite cruel, and I don't buy that argument, because everybody pays taxes. You need to look into the tax structure, the direct taxation and indirect taxation. And of course, the indirect taxation component in the overall tax structure is quite huge, and you cannot say that only a few segment of Indian population is paying taxes. Poor people do pay tax. So that cross-subsidizing poor people using the taxpayers' money, that argument I don't buy. So that should not be hindering, from, framing many policies related to how to tackle the uneven recovery, because recovery is there, but the recovery is uneven. And outside the purview of this budget announcements, and all, I do believe that there will be a kind of economic stimulus package to tackle what is happening at the lower end of the pyramid. And that, as the student rightly pointed out, that's a matter of concern. And from the monetary policy side, inflation, how they can contain, that will help the poor people, because inflation containment is a sole mandate of RBA right now. I hope that I have addressed all the questions.
Yes. Thank you, ma'am.
Another question came up in the end. Ma'am, another question came up in the end. That is, ma'am, when you spoke about one paper, the R&G relationship. So one student is asking if you could throw some light on that concept.
Sure. High debt and high fiscal deficit, in general, students or, policymakers, even the public, when you look into the calculus of consent, people go and vote the government, then in the back of their mind, if they're thinking that this government, they have huge mounting public debt, why should we vote them back to power? Because, the future generations will also be in debt if you vote them back to power. So these kind of questions about the public debt, that's very crucial, and it affects the calculus of consent or the voting behavior of the people when they look into, in retrospect, what government has done. So public debt is an important thing. Now, what Indian government articulates is that, of course, we have high debt, we have high deficits, but we will grow out of it. Using that debt, we're creating assets in the economy using the capital formation. So G is actually growing out of debt. R is your cost of credit. And if the real cost of credit, the real rate of interest is greater than the real growth of economy, then you're not growing out of your debt, right? But if G is greater, then you're using that, high debt or high fiscal deficit to grow. So if it is used for the growth path, if it is for the robust growth path, that's welcome. And if it is for fiscal profligacy, of course, it will not lead to, increased growth in the economy. So that's very crucial. So high debt and high deficit is good, but R greater than G is an unsustainable debt situation. So if you are getting into an unsustainable debt situation, then you cannot go along with the bond financing of deficit. You have to eventually monetize the deficit. So that exactly is called unpleasant monetary arithmetic. Here, the monetary arithmetic is unpleasant. Why? Because beyond a point, when R is greater than G, you have to stop bond financing and you have to, eventually monetize your deficit. So why we have taken a path away from the seigniorage to the bond financing to control the inflation. But inflationary pressures can happen even after doing this bond financing, the moment R is greater than G. So when the R is greater than G, you will eventually monetize your deficit and inflation may go up. So inflation today or inflation tomorrow, that's only flexibility you have. But inflation is a reality. That's why it's called unpleasant monetary arithmetic. But what's an alternative? Unpleasant fiscal arithmetic. And what exactly is unpleasant fiscal arithmetic? In this, tug of war between the fiscal policy and monetary policy, in the unpleasant monetary arithmetic, fiscal policy dominance is there, monetary policy follows. But in unpleasant fiscal arithmetic, central bank independence is there. But of course, in the context of Indian economy, there is no goal independence because the goal of the central bank is price stability. But we have operational independence in the sense, instead of RBI governor taking the decisions, now is the monetary policy committee. That operational independence, of course, we seek. But unpleasant monetary arithmetic says that the central bank independence is there and the fiscal policy will be the second mover. The first mover advantage has gone away from the fiscal policy to the monetary policy maker. So these are the two important macro policy scenario in front of us, and the debt unsustainable situation of R greater than G is an unpleasant monetary arithmetic. That's it. We need to eventually monetize deficit. And this is, of course, the argument by our chief economic advisor, former chief economic advisor, Kaushik Basu, Nobel laureate Abhijit Banerjee, Kartik Mahindra, the industry joint. So they all arguing for a re-emergence of the monetized deficit, the money financing of fiscal programs. Why? Because in the time of crisis and the time of pandemic, if public policy, the public finance, the budget makers, they take a stance that, where is the money? We have to use that revenue stability assumption for our expenditure design. The moment they get into that mode of revenue stability decides expenditure decisions, the moment the revenues are uncertain, the question can be asked, where is the money? Within the limited money, we will. But that articulation is quite cruel because we have intention to support the uneven recovery, but everything we cannot do because we don't have enough fiscal space. That can be quite cruel. So what's an alternative when the fiscal proceeds from the privatization is not working out? What is the alternative? In that realm of thinking process, Abhijit Banerjee mentioned that a finite monetization of fiscal deficit can be a plausible solution. But there's a piece by IMF recently that there is kind of a taboo towards monetization of deficit right now. Because we think that inflationary pressures, fiscal profligacy will mount, so that taboo is there. But even in the thought process of IMF, quite a bit of rethinking that's happening, whether we can open up a finite money financing of fiscal deficit. It's not like a helicopter money or anything which drops the money into the hands of people, but a finite money financing of which fiscal program, that we need to decide. Like whether government acting as an employer of last resort, or whether it is designing a judicious mix of a cash transfer program, or whether we are getting into financial inclusion and digital infrastructure. So those programs, government can decide, but that finite linking of the money financing a fiscal program, that could be quite a plausible solution if your R is greater than G. Then your debt is unsustainable, and you have to think about monetization of deficit. I think it's clear. Okay.
Yes, ma'am. All the questions have been answered. Thank you, ma'am, for such an enriching and insightful session. It was a delight to see our participants engage in the session. So before moving ahead, I request all the participants to fill the attendance form, the link for which has been shared in the chat box. Now I would request Dr. Shilpa Chaudhary to give a vote of thanks.
It was indeed our pleasure and honor to have Professor Lekha Chakraborty as a distinguished resource person amongst us today. Thank you so much, ma'am, for accepting our invite and for sparing some of your precious time. Thank you so much for giving this wonderful opportunity to have interacted with you. Thank you so much for giving such useful and comprehensive insights and exposition into not just the issues of public finance, but the overall arena of macroeconomics as such. You have answered each query in such a detailed manner and in such a lucid manner, ma'am. I'm sure this session has been truly very useful for each one of us today. Thank you so much, ma'am. I would also like to place my thanks to Dr. Trisha Jolly for facilitating this webinar and coordinating with our resource person. My thanks are also due to our association in charges, Mr. Deepak Manchanda and Ms. Deepthi Sethi, and each member of our students' union who have put in all their efforts in putting this event together and also ensuring its smooth conduct. Last but not the least, I thank all our participants, our audience who joined us today, faculty as well as students. We really hope that this session has increased our understanding of various macroeconomic policy issues, that it should be a dynamic one, it should be an adaptive one, and the whole notion of thresholds needs to be given a rethought. So thank you so much, ma'am, for giving this opportunity to each one of us. Thank you.
Thank you, ma'am. Now, this is a reminder for the participants who haven't filled the attendance form to kindly fill, and they can now leave the session. Thank you, everyone.